Welcome everyone to our market update for April. I want to start off with a quick recap first from our last meeting in December, where we discussed the gold price and the impact on our portfolios, as well the AI technology stocks that was quite getting a lot of attention in the market. So very briefly, looking at the factors that we identified that could potentially drive the gold price into 2026, the one that we focused on was geopolitical risk. And boy, were we basically surprised how quickly that changed. Our view was for risk to de-escalate, but the Trump administration had other plans. And early in January, events in Venezuela, then discussions about Greenland, and then recently the conflict in the Middle East, all basically increased geopolitical risk. What's interesting though is that the impact on the gold price was actually counterintuitive, where we would expect the gold price to increase as the risk escalates. The gold price actually declined at first, and I will show you some slides on that a bit later on in the presentation. The other factor that we focused on for the gold was central banks. Our view there was that central banks will potentially continue buying if the price is right. And what we've witnessed during the quarter of this year is basically that retail investors and consumers of golds, especially on the jewelry side, were selling a lot of gold. And you can see the decline from jewelry and the decline from investment, which is basically from exchange traded funds, which sold out of gold on the fear of rising inflation and potential risk spilling over into the equity markets. Then on inflation expectations, very much in line with what our views was last year. Obviously, the events that are unfolding now with the impact of the conflict in the Middle East on energy prices, we basically are seeing a sharp rise in the inflation expectation. So the graph here is showing you what the market is expecting the 5-year average inflation rate will be 5 years from today. So it's a forward-looking measure. But what's important is to note the increase. So you can see that inflation expectations are rising the longer the conflict persists. And that's basically due to the potential impact on energy prices. And then the last one that we monitored for the gold price was the movement of the dollar. But as I mentioned, the geopolitical events actually overshadowed the dollar's movement. So the dollar reacted as a safe haven asset. So you can see here, as the conflict started in the Middle East, the dollar actually started to gain ground against its competitors. And then during April, when there was the first ceasefire was announced, the risk declined again and the dollar came back. So show you just how quickly events can change. And when we look at the gold price since the start of the year, you can see in January, it basically ran up by $1,000. How quickly it came back. Then it started to increase again. And then at some point, retail investors got concerned about the impact on broader equity risk. And you can see how it actually started to come back again. So overall, gold price is slightly higher, but it just shows you how quickly the markets can change and how dangerous it is trying to make short-term expectations on the markets. Then just very briefly, the other theme that we monitored last year was the risk of a bubble in AI companies. We focus on valuations and then the risk on the balance sheet or the leverage. And just a quick update on that. What you can see here, if we look at the valuation and we look here at the price to earnings ratio, you can see basically that the ratio actually came down into March, and towards the end of March started to increase again as the risk started to escalate. So overall valuation slightly lower for AI stocks. If we look at the debt to assets as a measure of balance sheet strength, we can see that's remained fairly stable during the first quarter. Then let's discuss themes that are currently driving the market. The first one is still AI, but it's definitely moved on from the big CapEx spenders into the potential beneficiaries of AI. We see a lot of stocks in the hardware space, so semiconductors especially is doing quite well. But the AI theme is still driving the market, predominantly on the equity side. And it's basically based on the expectations for an increase in CapEx spending and the impact it will have on productivity. So as I mentioned, semiconductors is doing well as the CapEx rollout continues. So we are seeing a shift from the big CapEx spenders into semiconductors. But the risk for us still remains that expectations is running ahead of actual earnings growth coming through, and the valuations is something we continue to monitor. The other main theme is kind of linked to AI, and it's the demand for energy. So the data centers that's being built to house the computing hardware requires a lot of energy. That is pushing up the demand for energy. But also linked to that is the conflict in the Middle East, where major economies is realizing that they need to diversify their own energy mix. Being reliant on a single source potentially creates problems if there is supply chains like we're witnessing now. And that's especially relevant for countries in Asia that's very reliant on oil coming through from the Middle East. And we are seeing movements towards countries trying to diversify into other sources of energy. And then the third broad theme is geopolitics. It's been slowly brewing over the last couple of years, moving from a period of strong globalization. It seems that countries are now focusing more internally, trying to secure their supply chains. In Europe, we're seeing a massive increase in the budget for defense. We haven't really seen the spending coming through, but the budgets are being adjusted to be more independent and no longer relying on the US for support. And as I mentioned, the critical focus on materials and technologies that is required to be more independent. So almost moving towards a more deglobalized world, which potentially could lead to higher inflation. And that is something that we are monitoring in our portfolios. And we have been positioning our portfolios for slightly higher global inflation. So against these three broad themes, we do need to focus on the short to medium-term risks that is currently in the markets. The one that is definitely standing out is the oil price, and to the extent that the market is currently still pricing in a very quick resolution to the conflict in the Middle East. The graph on the left shows you the dark blue line is the spot price for oil, so the price where it's currently trading. And then the light blue line is where the market is currently pricing oil prices in 12 months. And what you can notice is that the oil price in 12 months is still sitting around about $80 a barrel. And the risk here is that the longer the conflict consists in the Middle East, this future price will rise, and that will place definitely pressure on inflation going forward. So currently the market is pricing in a quick resolution. If that doesn't play out, we can potentially see an increase in inflation expectations. The graph on the right, you can see basically just shows us that oil spending as a percent of GDP is actually quite low. It's not as high as it was previously. So the impact of higher oil prices is much lower. And here you can see the oil intensity measure. So basically the volume of consumed oil per unit of gross domestic product. So the impact of oil on your economy is quite low. Having said that, it's still the risk that the market is pricing in a quicker resolution that might play out. For South Africa, obviously, that poses a risk as an oil importer. We've already seen on our own market the increase in petrol prices. That has a knock-on effect for inflation, and that has another effect basically for our interest rates, which potentially then could increase to fight inflation. What we just want to highlight is also it has an impact on our equity market. Higher interest rates obviously means that the consumer remains under pressure, so consumer spending declines. And what we're showing you in this graph is just the sensitivity of our equity market to a 10% increase in the rise in oil prices relative to the global equity market. So what this graph is telling us, the higher the oil prices move, the weaker our equity market will perform relative to global equities. And you can see India and China is also basically in the same environment because they are also major oil importers. The other risk, and we've touched on it in our last review as well, is the fact that the equity market in the US is still very positive on the impact of AI spending and the CapEx spending basically driving that. And this is a very good summary of the risk that we think is in the market. So if you look at the black line, which is the US job openings, as a broad measure for the US job market, and you can see what's been happening since 22, job openings has been declining. And there used to be a very strong trend between the US equity market and the job market because the US is a very large consumer market. A lot of the earnings that's being delivered to the equities comes from consumer spending. But around about 2022, 2023, you can see, despite the fact that the job market was cooling, the equity market continued to increase. So you can see there's this strange gap opening up here. And the reason for this is the equity market is now being driven by CapEx spending. So a lot of the spending by the large technology companies on capital expenditure is keeping the market going up. If this CapEx spending doesn't feed through to future earnings growth, the realization could come to the market that the consumer is not healthy. And this is the risk that we are concerned about and the reason why we're not aggressively overweight into these technology companies. Then, as I mentioned, the demand currently from data centers for energy is outstripping the supply. So typically when demand is more than supply, you would see the price increase. And here you can see the average electricity per kilowatt hour cost for the US cities. Since basically just after COVID, you can see that it's actually been increasing, and it's predominantly been driven by this demand from the big data centers in the US. Again, higher energy prices feeds into inflation, and it also takes spending away from the consumer into other products. And that has a potential negative impact on your consumer-related companies in the market. So against the themes and the risk, very briefly, how are our portfolios positioned? In our balanced portfolio, we've added uranium exposure. And the main motivation for this allocation is, despite the uncertainty around when the conflict could end in the Middle East, longer term, we do think that especially Europe and Asia needs to reevaluate their dependency on energy sources from high-risk countries. So for Asia, it's predominantly the oil coming from the Middle East. Europe is the same problem, but then also their natural gas is coming from Russia. So they need to change the energy mix, and we think nuclear is the potential winner in this space. And we can see that the demand leading into 2040, so over the next 15 years or so, the demand will outstrip supply, and that should lead to higher prices. and motivates our decision to increase our exposure in uranium. Then very briefly, just on the AI and the infrastructure, especially the commodity energy infrastructure need in the market. I just want to highlight that when we look through our portfolio holdings and the allocations from our active portfolio managers, we are exposed to some of these themes. Bailey Gifford, which is a portfolio manager based in Edinburgh, Scotland. I'm just highlighting some of their holdings in their portfolio. So a very big holding in SpaceX, and then also exposure to ByteDance, which is TikTok's holding company. So with a lot of the AI, we are seeing a lot more users going on to TikTok, driven by the AI agents. And then Anthropic is an AI company in the US, which is probably well known for Claude, which is their language model that they're using a lot of tools being rolled out. So we get exposure to these companies from Bailey Gifford. Goldman Sachs portfolio that we have with Goldman Sachs, Core Scientific in the data center space, Lumentum also very much linked into data centers. They're more focused on fiber optics technology, and then Vertiv is more focusing on the cooling systems for these data centers. If we look at the infrastructure side, two of our asset managers that we use, Global X from, you can see they have Diamondback, which is a natural gas and oil company in the US, Devon Energy, also in the oil and natural gas, and then CF Industries, which focuses on fertilizers. So this plays into that infrastructure theme that I've mentioned. And the same with Research Affiliates. Three of their companies is also in the energy space. You can see PBF, Plug Power, and then Weatherford, which is basically providing the services for the industries. So we do have exposure, but as I mentioned, we are cautious. We do think the prices has been running ahead of the fundamentals, and in that environment, we think the risk is a bit too high to be overweight. But we do have exposure to these themes in the market. I thank you for your time, and I hope you all keep well.